It begins with tension. Diplomatic relations between the United States and China, already strained over trade, technology, and geopolitical influence, reach a breaking point. Skirmishes in contested territories escalate, cyber attacks cripple critical infrastructure, and political rhetoric intensifies. A military confrontation becomes unavoidable, drawing the world's two largest economies into conflict. The first economic shock is immediate uncertainty. Financial markets react violently to the news of war. Stock exchanges plunge as investors panic, fearing disruption of global trade, supply chain collapse, and corporate losses. Indices such as the Dow Jones, S&P 500, and NASDAQ experience historic volatility. Safe haven assets like gold and U.S. Treasury bonds initially surge, while equities tied to international trade, technology, and manufacturing collapse. Investor confidence evaporates. Corporate America faces immediate operational disruption. Multinational corporations reliant on Chinese manufacturing or supply chains experience severe delays and cost increases. Technology firms dependent on Chinese components, automotive manufacturers sourcing parts from Asia, and consumer electronics companies face logistical nightmares. Production halts, shipping disruptions, and surging costs strain corporate balance sheets, forcing emergency measures. The banking system comes under pressure. Corporations drawing on lines of credit to manage inventory and operational costs strain liquidity. Banks, exposed to global trade risks and corporate defaults, tighten lending. Borrowers struggle to meet obligations, and banking regulators face extraordinary challenges. Credit availability contracts, further stressing corporate operations and household finances. The U.S. government ramps up military spending. Defense budgets surge, reallocating funds from domestic programs to support war efforts. Taxation, public debt, and federal borrowing increase dramatically. Infrastructure, education, healthcare, and social programs face cutbacks as government resources are diverted to fund conflict. Bond markets respond to rising debt issuance, increasing interest rates and creating fiscal pressure. Employment is affected across multiple sectors. Defense contractors and military suppliers experience a boom, while civilian industries reliant on trade, logistics, and manufacturing face layoffs. High-skilled technology jobs are disrupted due to supply chain issues, while retail, hospitality, and service sectors contract as consumer confidence drops. Unemployment rises unevenly, with certain sectors benefiting and others collapsing. Consumer behavior shifts dramatically. Fear of economic uncertainty, job losses, and rising costs reduces discretionary spending. Retail, tourism, and leisure sectors contract sharply. Households prioritize essentials, drawing down savings to cover basic living costs. Economic contraction becomes self-reinforcing as reduced demand leads to further layoffs and business closures. Global trade faces unprecedented disruption. China, as the world's manufacturing hub, becomes largely inaccessible to U.S. companies. Import-dependent industries face shortages of electronics, textiles, machinery, and consumer goods. Export industries face retaliation and sanctions, reducing international revenue streams. Shipping routes become high-risk zones, increasing insurance costs and delivery delays. The stock market remains volatile. Technology stocks, heavily reliant on Chinese manufacturing and markets, experience significant declines. Financial institutions exposed to global trade, debt, and currency fluctuations are destabilized. Market indices swing wildly as news of battles, sanctions, and economic fallout drives investor sentiment. Retirement accounts and institutional portfolios face cascading losses. Energy markets experience price shocks. Disruption in global shipping and uncertainty over trade routes impact oil and gas supplies. Energy prices spike, creating inflationary pressure. Domestic energy producers adjust production to mitigate risk, while consumers face higher costs for transportation, heating, and utilities. Commodity volatility extends to metals and agricultural products, affecting industrial production and food prices. Supply chains for manufacturing are severely impacted. U.S. factories dependent on Chinese components struggle to maintain production schedules. Automotive, electronics, and machinery industries face shutdowns and delays. Inventory shortages drive up costs, while businesses seek alternative suppliers at premium prices. The efficiency of domestic and global supply chains collapses temporarily. The technology sector suffers particularly hard. Semiconductor shortages, disrupted electronics manufacturing, and delayed shipments of components halt innovation pipelines. Software and hardware companies dependent on international collaboration face setbacks. Investors reassess valuations, and tech-heavy indices experience sharp declines. Startups reliant on venture capital face funding difficulties amid market uncertainty. Banking and financial institutions grapple with heightened risk. Cross-border loans, trade finance, and foreign currency exposure create instability. International investors reduce exposure to U.S. assets due to geopolitical risk, creating capital flight. Currency volatility affects both domestic and international transactions. Hedge funds and institutional investors implement risk-reducing strategies, further amplifying market fluctuations. The housing market experiences stress. Rising unemployment and economic uncertainty reduce demand for housing. Mortgage defaults increase as households struggle to meet payments amid inflation and job loss. Real estate investors face declining property values, particularly in regions reliant on trade, technology, or manufacturing. Commercial real estate experiences similar contraction, with businesses reducing office space and retail footprints. Corporate debt levels become a major concern. Companies reliant on international operations face declining revenue while servicing pre-existing debt. Defaults increase, creating cascading effects across lending institutions. Corporate bond markets experience increased yields reflecting higher risk premiums. Legal systems are strained with bankruptcy filings and debt restructuring cases. Global financial systems are impacted. International markets connected to U.S. China trade experience volatility. Supply chain disruptions, sanctions, and investment uncertainty create ripple effects in Europe, Asia, and emerging markets. International investors reallocate capital, currency exchange rates fluctuate, and global economic growth slows dramatically. Insurance and risk management sectors face unprecedented claims. Property damage from conflicts, disruption of supply chains, and increased business risk create a surge in claims. Premiums rise sharply and coverage becomes more restrictive. Reinsurance markets adjust to new risk levels, adding further cost to businesses and individuals. Agriculture experiences both disruption and opportunity. Exports to China are blocked, affecting American farmers. Domestic prices fluctuate due to supply chain issues and changing demand patterns. Certain agricultural sectors benefit from increased domestic demand, while others suffer from lost export revenue. Food processing and logistics face operational challenges. Defense and security spending dominates the federal budget. Fiscal reallocation reduces resources for education, healthcare, and infrastructure. Public programs are deferred or canceled, increasing social tension. Rising debt issuance drives interest rates higher, compounding economic stress. Inflationary pressures increase as government spending competes with private sector liquidity needs. Transportation networks are under strain. Military mobilization and shipping disruptions impact commercial transportation. Freight companies face delays, increased costs, and logistical complexity. Public transit experiences service reductions in urban areas as resources are diverted. Aviation faces higher insurance costs, reduced international flights, and operational uncertainty. Employment in defense sectors grows, but civilian employment contracts. Manufacturing jobs dependent on global trade disappear, retail and hospitality shrink, and technological jobs face delays due to component shortages. Workforce retraining becomes a necessity, but availability of programs is limited. Social dislocation grows as unemployment becomes widespread. Consumer markets contract. Luxury goods, non-essential services, and entertainment sectors collapse. Essential goods experience price inflation due to scarcity and logistics costs. Consumer confidence declines sharply, reinforcing economic contraction. Household savings are depleted as families struggle to maintain living standards. Small businesses face existential risk. Reduced consumer demand, increased operational costs, and disrupted supply chains push many to closure. Retail stores, restaurants, and service providers are particularly vulnerable. Local economies dependent on small business activity experience sharp contraction, increasing unemployment and reducing municipal tax revenue. Corporate investment and innovation are delayed. Capital expenditures, research programs, and expansion plans are postponed due to market uncertainty and financing challenges. Long-term productivity growth slows as businesses prioritize liquidity and survival over innovation. International competitors capitalize on U.S. market instability to capture market share. Energy infrastructure experiences strategic pressures. Increased military activity strains oil and gas logistics. Renewable energy projects face delays as resources are redirected. Domestic energy costs rise, creating inflationary pressure across industrial and consumer sectors. Energy-intensive industries reduce output to manage costs. Public trust in institutions is challenged. Government focus on war effort creates perception of neglect for domestic welfare. Civil unrest increases in response to economic hardship, service cuts, and social inequality. Protests, strikes, and regional disturbances create further instability, complicating recovery and social cohesion. International markets respond with caution. Countries reliant on U.S. China trade recalibrate supply chains, diversify markets, and adjust foreign policy. Emerging markets face both risk and opportunity as global trade flows shift. Commodity prices fluctuate due to uncertainty in energy, metals, and agricultural markets. International financial institutions implement risk mitigation strategies. Corporate bankruptcy rates rise. Companies with high debt, reliance on Chinese inputs, or international exposure default at higher rates. Bankruptcy filings surge, legal systems are overwhelmed, and recovery for affected employees is uncertain. Market confidence erodes further, creating a self-reinforcing cycle of financial instability. Healthcare systems face indirect consequences. Economic stress, reduced government funding, and civil unrest strain hospitals and clinics. Public health initiatives are delayed, chronic disease management suffers, and healthcare access is uneven. Vulnerable populations experience higher mortality and morbidity, amplifying social tension. Education and workforce development are disrupted. Schools face funding cuts, program closures, and delayed educational initiatives. Universities dependent on international students or funding sources experience enrollment declines. Workforce skills gaps increase, complicating economic recovery and long-term competitiveness. Global economic influence of the U.S. is challenged. War expenditure, domestic economic contraction, and trade disruptions reduce international leverage. Geopolitical rivals capitalize on U.S. distraction and vulnerability. Strategic alliances are tested as global markets adjust to uncertainty. Social inequality intensifies. Wealth disparities increase as those with access to financial resources navigate uncertainty more effectively. Middle and lower class populations face reduced purchasing power, unemployment, and reduced access to essential services. Social unrest grows, reinforcing political polarization. Stock markets fluctuate violently. Indices respond to war news, trade disruptions, corporate earnings, and investor sentiment. Retirement accounts, pension funds, and institutional investments face steep losses. Volatility persists as uncertainty dominates financial decision-making. Hedge funds and investors implement defensive strategies, but confidence remains low. Recovery is slow and uncertain. Post-war reconstruction, supply chain normalization, and economic rebuilding require decades. Corporate restructuring, workforce retraining, and fiscal stabilization dominate government policy. International trade patterns adjust permanently, and global economic hierarchies are reshaped. Ultimately, a U.S. China war scenario creates unprecedented economic, social, and financial disruption. Stock markets collapse, corporate America faces systemic stress, unemployment surges, consumer confidence evaporates, and global trade suffers. Recovery demands strategic policy, private sector adaptation, and societal resilience. The scenario highlights the profound interdependence of geopolitics, commerce, and economic stability in the modern world. The story of a U.S. China war underscores the fragile balance between national security, economic prosperity, and global financial stability. It demonstrates how geopolitical conflict can trigger cascading effects across Wall Street, Main Street, and international markets with consequences that last for decades.